Okay, hello everyone. This is Darris Cassidy. We'll get started in just a minute. It's 11:30 at the moment. My co-host Matt is looking for the Zoom link here, so he'll be on in just a moment. And if not, we'll start without him. But I see some more people coming into the meeting now, so we'll give it just one or 2 minutes, then we'll get going. All right, hello everyone. Again, this is Darris Cassidy. I am a principal at Verivest as well as Fairway America, as you can see there in the background. Today, we're going to chat about capital raising. I'm going to be joined by Matt Burk once he finds the link for the Zoom meeting, and we'll be joining here hopefully shortly. But meanwhile, we can kind of dive right into how to raise capital. And I think specifically, we'll talk a little bit about how to raise capital into syndications, but primarily want to cover raising capital into pooled investment funds, since that is the majority of the clients that we work with are fund managers and or considering starting a fund. So with that, we will jump right in here. So a little bit of background on Matt and myself. Again, Matt founded Fairway America back in 1992. We've been longtime fund managers. I've been with Fairway since 2012 as a principal and the primary capital raiser for Fairway and our investment business on that side. We'll probably talk a little bit more about how the two link together. And I see Matt joining now. So, hey, Matt, you're on mute.
I made it. Yeah.
All right.
Technical
Technical challenges. Right. So anyway, all right. So I just kind of gave a high-level intro as to what we're talking about today with capital raising. Going to focus on pooled investment funds and a little bit about yourself being the founder of Fairway America, started back in 1992. We are in the process of launching what will be our 12th fund. So collectively, the two of us have raised somewhere around $1 billion, both primarily into funds, but also into single asset syndications. And through Verivest have consulted on roughly 300 engagements to help people kind of structure their funds properly, launch those discussions around capital raising, management of the funds. And then of course, we provide administration services for funds. We have about $3 billion of investor capital that we administer on behalf of other fund managers around the country. So that's a little bit of background on the two of us. Again, you can find more of the information on our services at verivest.com, and I'm sure we'll talk a little bit more about those toward the end of the presentation. So capital raising, as I mentioned, I've been with Fairway America for a little over 10 years and been the primary capital raiser for Fairway. Prior to me joining, I guess, Matt, you were the primary capital raiser for some of those past funds. So I think we both can bring some experience and knowledge to our listeners here. But the first note that I had here, and it's kind of shown by this illustration, but just that a lot of people approach us and are kind of looking for that silver bullet of capital raising and looking for the easy button on how to go about it, which there really is not an easy way to go about raising capital. I think we'll talk through it a little bit throughout the presentation, but I think we've tried just about everything we could conceive of over the years as to how to raise capital. And some of those things have worked and some have definitely not worked. And of all the things that we've tried, there really hasn't been one strategy that we have found that, fulfilled as much capital needs as we had. So in my mind, and Matt, let me know what you think about this, but it's really doing a lot of things and prioritizing the things that you're doing. And I think the focus of this is really how to begin capital raising for a fund. So, Fairway's in the process of launching a brand new fund over the coming month or two. And in my mind, it's, when you're at that stage of launching a fund, how do you start the process of going about it? So I don't know if you have any thoughts. I know you've spoken to hundreds of managers and that are really looking for that easy button, and there just isn't one, right? What do you think about that?
No, there isn't one. Well, I guess in rare cases there might be one. Like I talked to a person the other day who was, I forget exactly how the conversation went, but one of his best buddies is a family office that is sitting on about 2 billion in cash, and he's going to put a few $100 million into. So, that does happen, but not very often. So, unless you have a ready-made source of capital that, you happen to grow up with or are independently wealthy, it's very hard. So people are starting at different places. I think people have different strengths and weaknesses and areas that they can focus on, but really no matter how you slice it, you're right, Darris. I mean, a lot of the people that come to us that we've talked to over the last, 10 plus years, sort of in a perfect world, they want somebody else to do it for them. They're just like, can you just raise the money for us? Well, no, not really. The manager, and I know you get into a lot of this, so I don't want to steal your thunder here, but you need to prepare yourself for a lot of different options. I think certainly we've tried a lot of things. Some work really well, some worked horribly. And it costs money to raise money. I mean, no matter how you slice it, it's expensive to figure out how to raise money. And so you want to choose your expenses wisely so that you get a good return on that investment.
Yeah. Not only does it cost quite a bit of money, but a lot of time, right? I mean, raising into a fund just takes time. And I think that's the other thing that I see clients not really appreciating is just how much time. And we'll touch on this, maybe some of the differences between raising for a syndication versus raising for a fund. And before we move on, let me just tell everyone, please, if you have questions along the way, feel free to throw those in the chat window. We may answer them as we go, and we may get to those toward the end. We'll have some Q&A time. We'll try and keep it to about an hour. So we'll get through our slides and then open it up some questions, but feel free to throw those in the chat window meanwhile. So just getting started. I mean, it's pretty daunting for people, how they're going to begin raising capital. And again, I think that's what we're going to focus a lot of this on is people are kind of hung up that they want a $100 million fund or a $50 million fund. But in my mind, when you're launching a fund, it's best to really chunk it down into, milestones. And that milestone may be your first $1 million or your first $5 million or wherever that may be. I think the real key to raising for a fund is catching the momentum and being able to create a process and pitch and something that you can replicate over and over again. And until you can kind of get those first dollars coming in, there's no real reason to stress about whether or not you can raise 100 million or so, whatever that goal may be. So really, I just like the idea of chunking it down into achievable milestones and going after those initial goals.
Yeah, and I would add to that, Darris, that I feel like when you set the fund up in the first place, one of the decisions that need to get made is what's the minimum offering, right? What's the minimum amount of money that you can raise and have the offering be live? And some of that will depend on what type of deals you're doing, right? If you're buying and fixing and flipping houses and you could do a deal for 100 or 2, right? You need a lot less money on your minimum than if you're buying a 500 unit apartment building that's cost 40 million bucks. Right. So to my mind, one of those first milestones is, can I get to the minimum? Does it make sense? Does the fund make sense if I raise considerably less than what my maximum offering is? So if I'm targeting 50 million, does the fund actually make financial sense for me and my investors at, at 10 million, if I only get to 10, right? And then if my minimum is 1, well, okay, that's my opening milestone. Get to the minimum first, or have that lined up before I start, right? So I can start buying assets, because it does get easier. I mean, it doesn't get easy, but it gets easier as you get going, right? And you have something there to show people. So to me, the first milestone is the minimum, and it's important to decide what that minimum needs to be so that it's financially viable for you as the manager and your investors, and then you work your way from there.
Yeah, I couldn't agree more. Going after that minimum is really, and opening up the fund, then you can start putting some assets in there, and by putting assets in, you can point to the assets when you're out raising, so the investor starts to get a flavor of the type of assets you're planning to put into the fund. The other thing I had as a note here, and is just a lot of people kind of get wrapped around the axle with the stress of how they're going to raise the fund, and a lot of people want to begin capital raising before they even have an offer, right? And they want to start talking to investors and getting feedback and seeing if this is marketable and will fly. And I understand the desire to do that, but for the most part, that what I've witnessed is that's just a waste of not only your time, but the investors' time. And, I think investors will be polite about it and say, sounds interesting, come back to me when you have a real offering. But a lot of that is just kind of spinning your wheels. There isn't a huge benefit to that, and getting investor feedback as to how you should structure it and this, that, or the other, it's not as helpful as I think a lot of clients believe it may be. So
yeah, I think it's worth considering, and it's worth doing with a limited number of people. But when you go out to people with, hey, I'm hypothetically thinking of doing this, it's hard to get their attention unless they're really someone that you trust and is willing to give you a bona fide opinion, and they're qualified to give you that opinion. A lot of it is just, what they say about opinions, right, Darris? They're kind of like, everybody's got one. So I think it's not worthless to do that, but you're right that people give it a lot more credence or importance than I think is reality. I mean, I did that the very first time we did a fund, went out and asked a bunch of people, and then it proved to be more or less, not valuable in the end. The people want to be nice in some cases. Yeah, that sounds good. That sounds interesting. But then, you launch the fund, and then you go back to them and say, oh, I'd never put money in that. Well, then why?
Yeah.
So.
Yeah, exactly.
And I know there's questions coming in. I don't know if you want to answer any of those or see them, Darris, but
I see those. Yeah, if you see any that you want to throw out there, but I mean, someone's asking, what's the percentage cost considered standard, or what's deemed acceptable in the market? And I am guessing they're talking about the cost.
That could derail us pretty fast there. But I mean, like the thoughts on raising capital for a fund via, exempt sub portal, and then through social media. Say, social media as a mechanism to attract investors. Yes, I think that's helpful. But like doing it through a portal exclusively, I have not seen a whole lot of funds be all that successful in hitting their targets through those kind of channels. So that's a great example of something where, I mean, I could give you a whole laundry list of things that seem like they could work, that cost a lot of money to go try, that I'd say the majority, if I was doing a statistical, analysis of 100 things, you could see that the majority of them will not be worth the money that you spent relative to the expectations that you have going at. I mean, it's probably 80% of things cost way more money than the results that you will actually get. And I would say,
and those things could be conferences, lists, placement agents, travel, meetings, events. I mean, things of that nature, right?
That's right. So I think the social media, is social media a good angle or tool to attract investors? Yeah, absolutely. Is it a panacea that's going to be something that's going to fill up your fund? I mean, almost certainly not the vast majority of the time.
Yeah, that's exactly right. All right, so next thing, and we just kind of touched on this a little bit, but having an investment offering is clearly important for the reasons you're out presenting an offering to people. So we touched on this a little bit, but it's just really important to understand your offering very clearly, what's in it, why is it structured the way it is, and be able to answer investor questions. I've seen a lot of people, and at Fairway, we get pitched with investments all the time from people. And if a lot of times we find they understand the real estate really well, they understand the nuances of the market, the strategy, and even the pro forma on the real estate. But when it comes to the actual offering and what it means to an investor, I see a lot of people really don't have the knowledge base that they should. And even if they've read the documents, they don't know why it is structured a certain way. So comments about that, Matt?
Yeah. I mean, it's super common, right? And this goes back to what I said at the beginning, where a lot of people are asked, they want somebody else to go out. I mean, we get this all the time, right? Somebody, hey, can you raise the money for us? And like, well, tell me about your offering. Like, and then they can't even tell you about the offering. I'm like, well, you're never going to go get somebody else to go raise money for your fund, because how are they going to get compensated and paid when you yourself as the manager can't even articulate what the offering is, right? So it's remarkable how common that really is, right? So understanding what it is that you're selling is an important first step. And to your slide here, having an investment offering, right? And again, we'll remind people that this is not legal advice. We're not lawyers. Always have a securities counsel to give you guidance on what you can and cannot do when it comes to selling, funds and securities to investors. But selling a hypothetical thing is a hard thing to do. So I'd say, to the last couple of comments, you got to balance the timing of deciding to do it and creating an offering with having some idea of how you're going to raise the money, so that you're not just spending money on a bunch of offering documents that you're never going to use, which does also happen, fairly frequently. So, that's all, that in my mind, that's all part of the value proposition that we bring. And that's hard to get in the market, where you have a balance of those considerations of, setting up an offering, spending the money to do it, but having some concept that you're doing it properly and that you have enough of a handle on what you're doing and a baseline that you can go out and raise the money, hit the minimum target and hit your goals. Right. And then at that point, then you start thinking about, here's all these different ways that we could raise capital. I know we're going to get into some of that stuff here today.
Yeah, and this touches on that. And I think that, we did just have a question come in. How do you get a deal if you don't have the investor capital, right? How do you secure that real estate if you don't have the capital? And that's the challenge that everyone has. And that is more so on the syndication side, but it is nerve-wracking and stressful that you're going to have to set up this offering, maybe put some earnest money down, tie up a deal, and have confidence in your ability to raise the capital. And you just don't know. And even the best in the business have that stress of, and it's a fire drill to, you're basically betting on just your confidence in being able to do that. And that can be really nerve-wracking to people. So
it's not for the faint of heart, right?
Otherwise.
Yeah, being a real estate entrepreneur is not for the faint of heart, even if you're, I say just syndicating, but syndicating is like, we talk about this all the time, right, Darris? That's like playing checkers, right? And checkers is like that. It's a fun game, and you can win a lot of games and you can play it, but a fund is chess, right? It's more difficult. So in the beginning, I'd say that's why you need to have an offering. Is if you have an offering, before you even tie up the property, right? Have an offering, know that you can raise the money, have at least some of it soft circled, right? And then you can go find the property and take it down. But you don't actually have to go all the way to the point of taking the money in. That's why you can get commitments from people, right? And if you can start small. I've seen lots of funds that are perfectly financially viable at relatively small dollar amounts, right? Depending on the asset strategy. And, at some point, it's like anything in life, you have to take the leap, right? And you just know that you're going to get blown around a little bit, because it's hard, it's part of what has to happen.
Yeah, and that kind of ties into one of the questions that we had is, how do you even size the fund? You just mentioned some of these small funds that do really well. And the question is, do you reverse engineer the size to what the manager's compensation needs to be to make it worthwhile? And it's a little bit of that, but it's also triangulating it right with how much deal flow can you do? How much capital can you or should you be able to deploy? Obviously, if your assets are $10,000 each, that's different than if your assets are $10 million a piece. So,
yeah. And and that's to that end there. That's why we do use tools like, modeling things out, right? And having variable based models that can help you decide, determine, what is financially viable and what isn't. And, there's all of those things that you can do in preparation to launching.
Yeah. And you touched on this a little earlier, but I see people or in my discussions that don't fully grasp this. But just because you say that it's a $50 million fund doesn't necessarily mean you'll ever get to $50 million. You may only raise 20 million, and it should be a viable fund if you can put enough assets for diversification purposes and to cover the expenses of the fund on an ongoing basis. So that is almost an arbitrary number.
Yeah, I was joking around this morning, right? We were talking about one of the funds we did in the past. Or, we make it's a 200 with this. You set it up because you have to pick, and what's a minimum offering, right? And what's your maximum offering? And the maximum offering is sort of only a marketing number because you're going to put in the documents that the manager can go beyond the maximum offering if it wants to. And that happens occasionally, but more often than not, people put a maximum offering, that is some crazy high number. So we, coming out of the Great Recession, and in our delusions of grandeur, said, our offering is $250 million. Well, hey, that sounded great. And then what did we get that fund to? Like 10 million
10 or 12 million.
Yeah. So we didn't exactly make a big dent in the 250 million, but the bottom line was the fund actually was quite successful. We've now wound that fund down, right, and paid the investors off, and that fund was one of the best performing funds we had, but it only ended up having $10 million. So, and it worked perfectly fine. The returns were good, and it all depends on what type of assets you're putting in there, right? So, the maximum offering is nothing more than what you're aspiring to try to hit. Now in a perfect world, you don't make yourself look foolish like we did and say you expect to raise 250 million bucks and only end up with 10. But
well, that's what makes us good advisors. So people can learn from our mistakes.
We've tripped over our own feet on many occasions. So
so this question comes up a lot in the capital raise, people wanting to know what investors are expecting, how much skin in the game should you put, how much to invest in your own fund. A lot of what we advise on to people, I think the dogma has been 10% is kind of where people land. But of course, if you're going to do $100 million fund, most managers, especially starting out, don't have $10 million of their own personal cash to put up. So does it need to be 10%? Does it not? I know, what we've historically said is that it should be a meaningful amount to that manager's personal net worth and financial situation. That seems to be a good answer to be able to give to investors. But there's other ways, right, to put skin in the game, such as getting seed money from other investors, right? So maybe touch on that a little bit.
Yeah, like most things, I'd say there is, how much should you put in? There is no absolute right answer, right? Obviously, investors like to see skin in the game, and they'll ask about that. So I'd say the more, the better. But of course, people have limitations on what you can put in. So I think, and there's some interesting resources out there, and these are more institutional, so I wouldn't take them as gospel because they don't all translate over. But I'd say the best answer I've ever seen is what you just described, Darris, which is, you should put in an amount that is meaningful to you based on your own personal capacity to do that. Darris's reference there at the end, and we've seen this and structured this. And in fact, our desire at Fairway is to work with managers to help achieve this, right? As you can obtain some amount of capital in the management entity that you can then invest in shares of the fund. And that doesn't have to come out of your own personal pocket, right? That can be a partner. That can be somebody who you come in and share the management entity with. It can be, a heavy hitter family office investor that you have. it can be a private equity group, and it can, but the idea is that the manager is putting some skin in the game, and that involves then, partnering with other people if you can't do it entirely yourself. So there are a lot of ways to do it. I'd say the upshot is you want to have something in there so that you can point to it, because, savvy investors, and the bigger the check writer on the investor, the more they're going to ask and pay attention to this stuff, right? That you have some amount of capital in there alongside them, so that you've got some skin in the game.
So getting ready to grind. I mean, I put this slide in here just because raising for a fund is an ongoing process. And somebody just asked this question, so good timing. Their question is, how long can the raise period be? If it's long, like a year or more, how do you handle the issue of pricing of early assets? And pricing of early assets, that's a net asset value for open-ended funds. That's a structural thing, so we won't get into that necessarily here. But regarding the raise period, and this is, for closed funds, you have a finite raise period. It's usually a year plus an extension. It can be some other time period. And then for open-ended funds, which Fairway has a few of those, you're raising indefinitely. We've been raising for some of our funds now for 9 years. And so it really is a nonstop thing, as opposed to, say, a syndication where you have a hard end date of when you have to close that deal, which is usually, within 90 days. So I think because of that, it's important to really prep yourself, or whomever is raising that capital from your team, that it needs to be something that gets attention and focus daily. It's not as much of the start-stop sort of raise that you go through with syndications. So really building processes around that, I think, is important.
Yeah, I think one of the big advantages of a fund over a syndication is that you're selling the same thing over and over again, right? A syndication, you're selling something different every time. So it requires different documents, et cetera. But
no, that's exactly right. I mean, and that is the beauty of a fund, is that once you can catch that momentum, then you can kind of get in this rhythm of a real sales process, and your marketing materials, and how you reach out and how you follow up. And an investor may not be ready today, but they may be ready in 6 months. All of those sort of things come into play that just really aren't there for syndication raises. I've got a quick question. Do we focus just on buy and hold real estate, or also on lending type funds? And we do all of the above. So lending funds, buy and hold, fix and flips, value adds, stabilized, any type of real estate strategy.
Debt, tax lien certificates, all different types of assets. We've done them all. Our background, or the first fund that I ever did, which is 1999, so we're on almost 25 years now, was a mortgage pool fund. So we've done a great deal of private lending mortgage pool funds. I'd say that was open-ended. Those were our kind of bread and butter for a long time. In the last 10 years, we've done hundreds of other types of funds at this point. So it's all of the above. Anything where you're raising money from investors to acquire real estate-based assets, in theory, at least, you can put a fund around just about any of those things. Sometimes it makes sense, sometimes it doesn't, but all types of strategies.
Yeah. So next thing we've got here, so as you kind of get ramped up to start raising and you have your offering ready to go, this may seem really obvious, but I see a lot of people struggle a little bit with this, is just building out a list. And that list doesn't, need to just be on one person. That could be with different members of your team. So what does that list look like? We have for years spoken about like these concentric circles. So you're going to want to start with the closest people to you, friends and family is the obvious comment, and then kind of work your way out from there. So I just threw some things on here as to what those lists may look like, or where they, depending on who you are. But for us, and raising from high net worths and accredited investors, the very bottom bullet point here, and I got asked this question as on a podcast yesterday, and they're like, who are these investors? What do they look like? I'd say if you took a look across our investor base, the majority of them would fall into one of these categories, being an entrepreneur, a doctor, dentist, attorney, and an executive. So that is the majority of the high net worth type investors that I've seen over the years. So marketing materials, a lot of people, want different materials. Pitch decks are an obvious one. But after you have that initial offering, I've found that a term sheet can be a very helpful leave behind or something to share with an investor. The PPMs tend to be very daunting for investors to work their way through. They're 100-ish pages, whereas a term sheet can kind of pull out some of the higher level details of what's in that document. Of course, having a website, a LinkedIn profile, obviously helps. And then as far as pitch decks go, I think you want those to be pretty short and sweet. Those pitch decks really shouldn't be meant to close investors. They should be more utilized as something that you can email to get a conversation started. So I think each one of these things along the way, understanding what your objective of that piece of material may be is important. I see a lot of people hoping that their pitch decks, raise money for them, and that just is hardly ever the case. It really has to do more with getting that discussion going and getting a level of understanding started with that investor. Anything missing here, Matt?
No, not really. I agree with that. I mean, you're not trying to close them with the deck. You're just trying to get interest. So, and I'd say you probably end up with more than one deck. You might have a really short deck and then a slightly longer deck, and you use them for different purposes.
I'd also say that decks evolve, right? I mean, like you build a deck and I just see so many people spend so much time trying to get the perfect deck, and within a few weeks you need to update that deck, and then a few weeks later update it again, and it's constantly changing.
You know how much money we've spent on decks early on, when like we're hiring a third party, somebody to put a deck, and then like you spend like weeks putting a deck together and drop 10, 15, 20 grand, and then like they go, oh, I hate this deck. Or like the next thing you know, you're changing the deck. Like, decks you need to have them. They're a necessary, part of the whole process, but you can easily get wrapped around the axle and spend a lot of money on decks needlessly.
Yeah. I think that's another thing, right? You probably can save some money by not hiring outside parties to do decks. And there's plenty of good people to build fancy looking decks, but you understand your offering better than anyone. And if you have basic PowerPoint skills, you can probably put together a deck that can function for you.
Yeah, I mean, look, when you get into the institution, like this is another comment to make, Darris. I think, we've talked about this for years. There's like this, what do we call it? The parallel universe, right? There's the way it's done in the institutional world. If you're raising money from, California State Pension Fund and the Texas Teachers Retirement Fund or whatever, right? And it's just different. So a lot of the dogma that comes out around how to run a fund and all the things you need to do with a fund is really more geared toward institutional stuff, which can you learn lessons from that stuff? Absolutely. But should you mimic it or follow that dogma blindly? Absolutely not, because it's a different universe. You're in parallel universes the way that you do something. So yeah, if you're Blackstone or you're somebody with a $2 billion fund, you're going to spend a lot of money on some decks, right? But if you're launching your first fund, then it's $5-10 million, $20, $50 million. I think, it's nice. You want to have it needs to look professional, right? Doesn't want to look like a second grader did it, but you don't need to drop, tens of thousands of dollars on decks.
Yeah, exactly. So initial outreach, I mean, obviously there's only a few ways to reach out to people, your prospective investors that come off that list, that being phone calls, emails, and in-person meetings. I think that you need to consider kind of how you like to be sold to. So, most people don't like getting a random phone call and catching them off guard when they're not expecting it, and then just launch right into some pitch, right? So I tend to start with emails and trying to get a dialogue going, use some of those lead behinds, such as your pitch deck, or maybe if you even know that they are likely to be interested, start with the term sheet if you have that sort of relationship. And then utilize that to lead to a phone call, or to lead even better to an in-person meeting. And then really understand that, as I said earlier, what is your objective each step along the way? I see a lot of people that try to, go right to the close, either through their marketing materials or in this initial discussion. Again, raising for a fund, you have a long period of time. So you really want to allow the investor to go at the pace that they are comfortable with, and not kind of put any sort of pressure on them. So that kind of leads to this. I mentioned this earlier, but we see a lot of managers that are just hardcore pitching the strategy and how great they are and their background, and they get really excited about the real estate, and that's good to have that passion, and that should come through. But you also need to talk to the investor as to what is in it for them. Speak to them about the benefits to them, the risks to them, why they may be interested or should be interested, why they should consider it, why they should care. So I don't know, Matt, if you have any, and everyone has their different styles, right? Like you and I even have different styles in how we raise money. So there isn't one way to do it or a right or wrong way. But my take is that not enough people talk to the investor's needs and the investor's wants. So.
Yeah, and I think probably the biggest mistake I see is, and you've pointed out a couple of times here, I don't know if everybody catches it, but subtle, is a lot of managers will talk to the real estate and the deal, and not necessarily to the fund and how it works and why it matters to an investor, right? And that's something that takes some time to get to. But you're right. It's like pitching it's kind of personal, and different people have different styles. But end of the day, it boils down to what's in it for the investor, right? It's like you start with their needs, their wishes, asking a lot of questions is the best way in my mind to pitch. Is like you want to find out about them more than just show up and throw up and tell them all about yourself, right?
Yeah, that's right. Yeah, and somebody just put in here, do you have advice or strategies when speaking with family offices? To me, it's the same as when you're speaking to high net worths. I mean, and family office is a term that just gets thrown around a lot, and there are definitely some real family offices.
Yeah, that's a whole topic. We could go into a whole webinar on family offices and share a bunch of stories and and what's worked and what hasn't. And at the end of the day, like I'll tell you something about Darris that I'll let you in on a secret about him. But the best way to pitch to family offices is to hang out with them, get to know them, and spend time with them so that they come to know who you are and trust you. Right. Because, the more money somebody has, the more if they're a real family office, and there's plenty of them that, will posture and pretend like they're a family office so that you'll pay for a bunch of free stuff, to take them somewhere, and then they never do anything. But if you're talking with a real family office with real money, like they don't want to be pitched. They don't want to be found. They don't want random people they've never met before calling them up with some offering. Right. Because it's just like, they feel they're getting taken advantage of by lots of people in their life. So their guard is up heavily, all the time. Right. So how do you really pitch that is you figure out a way to genuinely hang out with them and bring value to those people. And it's a commitment of time and effort to do it. And, Darris has done it for years and years. He's way better at it than I am. Right. Like I don't personally end up doing a whole lot of that stuff. Darris does, but that's partly Darris's personality. Right. And that's who he is. Right. And I think, if that's another thing for managers is you build a team of people like, Darris and I have different strengths and weaknesses. And, you build a team of people that learn how to, hang out with and can hang out with family offices. So it like most of this stuff, there's a lot of dogma, a lot of misconceptions in our experience, and having done it for as long as we have now, it's like you learn the hard way. So I'd say hang out where they hang out and do the things that they do, and don't try to run in there and pitch them your deal straight away. Bring them some value first.
That's exactly right. And this came up too on the podcast I was on yesterday. And I think people were pretty surprised. It led to quite a few discussions around this concept that I don't know that I ever ask someone to invest. I don't say, hey, do you want to invest in this thing? Or will you invest in this thing? It's implied along the way that I raise money for investment opportunities. And by hanging around and being myself and being genuine friends with high net worth people and meeting their friends and working that network, they'll let you know when they want to have that conversation, and then they'll let you know when they want to invest. And again, that's my style. That works for me. Other people might do it a little different. But I have found that works really well, and it leads to them being comfortable to introduce you to their friend, because if you're this hardcore, high pressure sort of person, then they're never going to want to.
That they've never met before, that they don't know from Adam, right? It's like you're going to get shut down pretty quickly. So I'd say, step one on family office is identify really who a family office really is, right? Because we've spent, I don't know, hundreds of thousands of dollars in pursuit of, family offices. We've gone to, it's another thing. I could tell some pretty funny stories, right, about some of the stuff that we've tried that haven't really worked very well. And
well, why don't you rattle a few off, because this is kind of our final slide, and then we're going to move into some Q&A. But rattle a couple of things off.
You want to hear my favorite one was the time I went to Monaco. Remember that? So we went to a family office thing in Newport, Rhode Island, and I don't remember what year this was, probably 13 or 14, something like that. Right. And then I met a guy who shall remain nameless there, who was, I'll call him a chaperone from some other person who was trying to raise money. Right. And then, he appeared to be somebody who was like going to be a shepherd, right, to help you come in and figure out who these people were. Right. And so then after we came back, and then like a couple months later, got a call out of the blue from this guy offering to help us, chaperone us to another family office conference that was in Monaco. It was like a last minute thing or whatever. we debated and all this, right? And we said, okay, well, look, it could be a scam, but it seems like it's worth it and all that. And so long and short, we did it, right? And went over there, and sure enough, like I got out and meet the guy, have a couple drinks, gonna meet him the next morning. He doesn't show up. Right? So I flew from Portland, Oregon to Monaco to go meet this guy, and then he doesn't show up, and then I'm there on my own. He finally shows up like 5 o'clock that afternoon, and he gives me some flim flam, bunch of story about something or other, and then he comes in, and he pretends to be somebody else. He didn't even pay at the conference, and so I spent 3 days in Monaco trying to figure out what the hell I was doing. Right. I don't know how much that ended up costing us, but here's how many investors we got out of that deal, was zero. So, and look, and it's easy to say, and certainly I was kicking myself in retrospect. That was pretty stupid, right, to do it. But like tons of people do this, not necessarily go to Monaco, but like believe in something that is bullshit, but you believe in it anyway, and you think that something on the other end of it's going to be there. So you spend a bunch of money. Frankly, that's a big part of what we're trying to help people do, is like avoid spending a bunch of money on things that are almost guaranteed not to work.
And that's why this is our final slide, beyond your network. I wouldn't even necessarily start paying attention to this if you're just getting the fund off the ground. Focus on everything we've spoken about. But to what your story, Matt, those things are out there, and they are often very tempting. And they seem way better than they are. I mean, you and I have also gone to Paris and England and the Middle East, and we've gone all over the world seeking capital.
Yeah, I remember that. Now that you mentioned that, I remember the other one, and we went to something in London. I forget what it was. It was a matchup that was put on by like the State Department or something, and that was actually legit. I mean, there were legitimate investors there. Right. It was like, but we came in with our fund. This was the $250 million fund that we had raised a few $1 million in, and came in to say, and then the one guy was like, we got like, it was a round robin. You'd go to different tables, you had like 10 minutes or 20 minutes with each person. We got there, inside of like the first 2 minutes, this guy's like, it's not investable. It's not investable. It's not investable. Right. Like, that's all he could say, is like, this fund is just not investable. Like, okay, so I guess we can take the next 18 minutes and, grab a coffee break till we go to meet our next person. So, and I don't know what we paid for that one, but I think we got about the same number of investors out of that one as we did the one long ago. And the only good thing there is we built a vacation around that one. So,
Yeah.
Anyway, I digress.
That is right.
The point is, be really careful about how you spend your money.
Yeah, and there's just so many tempting things, conferences, and there can be some good conferences, and you can get some ideas and maybe bump into someone. But I mean, starting with the basics of what we just laid out, starting with the people the lists you can build, working your own network, getting referrals is really the key. So we have a few questions. We've got about 15 minutes left. And for those that are interested in our advisory businesses, which is, helping set up and create funds, or even talking to you about whether or not a fund may make sense for you or your strategy. We do fund administration. We can also administer syndications. We also can create syndications. We have a product on our website called Fund Builder. You can create your syndication documents by just answering through the questions there on Fund Builder to do a syndication, and a number of other things, financial modeling, capital raise coaching. So a lot of what we've described here, getting a little bit more personal to your situation on going about raising capital. Not that we're going to do it for you, but basically share our experiences and an outline of all of the things we've done, some of the things you may consider, and helping you formulate that plan. So if you're interested in any of that, Kellen Stevens is the guy to reach out to. His information is here on the screen, and as well as verivest.com. So with that, we do have some questions here. If anyone else has questions, throw them in the chat window. So advices, we got a few on the family office topic. So we touched on that. Maybe we'll circle back around if any other comments come up, or if someone has a more precise question about family offices. We have, let's see, is there a hard line in the sand which groups you can solicit? There are a bit of differences between posting on local pages and posting on to the entire LinkedIn network. There really isn't, unless you have a 506B. Right.
Yeah, I was just going to say, Darris, I would say, again, we're not lawyers. We're not giving legal advice. Make sure you're talking to lawyers, because you can get very tricky on who you can solicit, who you can't, whether or not you need to be a registered representative and things like that. So always get securities counsel advice there. I think if you need to be a 506C offering, which allows you to publicly advertise and solicit. And if you're going to do that, you can only take accredited investors, and you have the burden of proof of verification of those investors. But assuming you're a 506C and you're advertising generally, there's really not a restriction on who you can advertise to, legally. And again, talk to your lawyer. Practically speaking, I think the way in which you post would be different if you're posting to a general audience and you're trying to just get awareness of your existence, versus if you're into a very specific group like a real estate group, right, where the whole purpose of coming there is to pitch or bring you whatever your services are. So I think you need to have a lot of arrows in the quiver on how you do it. There's no one size fits all. It needs to be appropriate for the medium that you're using.
Mm-hmm. So we have a question here. How do you pitch so it doesn't get awkward with friends that you see every day when they're investing and have money, but they're not investing with you? So what's the narrative you use to keep it cool? I mean, for me, I'm just genuinely myself, right? Yeah, and I deal with this a lot. I'm genuinely friends with this sort of situation and people that have money, and that's the answer, right? I just treat them like any other friend. I'm myself around them. My wife and I hang out with them and their spouse and go to parties or dinners or have them over to my house. And sometimes they ask about business and investments and we'll chat about it. And sometimes they don't. And I don't force the conversation unless it's genuine and something that I'm talking to them about as a friend. But, coming across desperate or really pressuring your friend is obviously not what you want to do. And to me, first and foremost, treat them like a friend if they really are that way. So that's what I do. And then what I have found is by doing that, my friends that are investors, they talk about their investments with me when I'm not around. And then that is what gets other friends interested to eventually consider investing with us. And so that's my approach to it. Is just be genuine to yourself.
Yeah, there's one here, Darris. Go ahead.
Go ahead.
No, go ahead.
Well, I was going to say that said, I mean, I'm friends with some extremely wealthy people that have told me straight out they won't invest, and they're a family office, and it's kind of like what you said earlier, Matt. I mean, they're just hit up and approached, and so for them, it was important to take that off the table immediately and make it clear, like, we're friends, but that investor discussion doesn't need to be part of our relationship, and they'll let me know if they change their mind, and I respect that approach as well. So that's, it is what it is.
Yeah, I was going to say that another question is around, can I seed the property with one that I already own? I've heard that you can, quote, mark it up. What's needed, credible to mark it up in terms of value added. That's a tricky situation. Again, not legal advice. You can mark it up. Very, very clear disclosures are extremely important. If you're bringing in things where you have a personal gain, that the fund is then benefiting. I'd say early on for managers, I would try to avoid that, because no matter how you slice it, there's some conflict of interest there. It's hard to establish what's a fair price. You'd have to substantiate and justify it, ideally with support from third parties, whether that's appraisals, or broker's opinion of value or whatever else, and then disclose. I would tend to, I've seen managers too, just bring it in at their basis, right? So ideally, you brought it in, you're not making any money off of it. Now, obviously, if you've owned it for 3 or 4 years and you've created a ton of value, I would say I'd rather see somebody go recognize the value with a third party buyer than bring it into a fund that you're going to manage and then benefit from, because now you're on both sides of the trade. And that's, it can be done. It needs to be managed very carefully with respect to the disclosures and thinking through like why, and being fair to both sides, and then being able to articulate that. But I'd say it's not really the best idea if you haven't really done that before.
Yeah. We have a question. Do y'all partner with GPs on deals? As you can see, yes, behind us on this side, Fairway America does, and that's our investment side of the business. So the answer is yes. We like to partner with GPs. That's a big investment strategy for us. That's part of the reason for Verivest, is to find great clients that we can help work with and create funds and help them grow and scale, and that helps our administration business, but it also helps our investment business. Yeah,
Verivest is a service provider, helping people think through, set up the funds, provide some tools and guidance and coaching and ideas on how to scale, and then doing the back office administration and accounting for those funds. Fairway is an investment manager that looked and uses the existence of Verivest as a way to help identify and find managers that we can invest, Fairway can invest in and alongside, right, and in a GP area. So happy to, on the Fairway side, love to chat with people if you got attractive, viable strategies. Happy to have that conversation. And whether Fairway invests or doesn't, Verivest value proposition is really helping people make good decisions on setting it up right in the first place, avoiding spending a lot of money on things that are never going to work on the capital raise, side, and then doing back office accurate accounting so that your investors have confidence that you're out doing the real estate and the back office stuff is being taken care of properly.
Mm-hmm. So maybe one more question, then we'll wrap it up here. Does Verivest provide marketing material when setting up a fund? And if so, is there an additional fee? The answer is no. We have over the years provided some marketing materials, but it's just difficult for the reasons we mentioned earlier, that it's kind of always changing, and picking different fonts and colors and this, that, and the other is not really interesting to us. So we'll review marketing materials as part of the capital raise help that we provide. and kind of give some feedback, maybe if you have a pitch deck, but we're not going to design it or create any marketing materials.
Yeah,
for the
it's
clients.
part of the coaching. I mean, that we do have, there's a big coaching component, right? Helping do a lot more of this stuff on a one-on-one basis with people, right? As you get the fund going, so we can get feedback on what you're doing and make suggestions and so forth. But we're, to Darris's point, we're not, graphic design shop and trying to, design all the PowerPoints for you. I think our experience is, it's very personal. People have very strong opinions about colors and logos and fonts and all that, and it's just so much back and forth. It's like, that's just not something we're involved in. So
great. All right, any final thoughts or comments here, Matt, before we wrap it up?
Yeah, I see some more questions, but no, I mean, I think the main thing I think is you'll see a lot of places out there that I think it's great to get people excited about setting up a fund. And obviously you have to want to do it in the early days, but I think our whole approach is like, we're not sitting here trying to tell people it's easy, right? Or that it's not going to be a lot of work, and that it's a sizable commitment. And that's why it's important to do it right in the first place. So hopefully, what we're trying to bring to people in these, webinars and also in any of the services that we provide is just, the real deal of what it's going to take, and help people, minimize the mistakes that they're making early on. And like I've told a few stories of things that, I can't say I'm super proud of them, or, that we made a lot, because we made a lot of mistakes. Right. And I know where a lot of the bodies are buried. So I think there's a lot of value in that kind of a thing. And that's what I encourage managers to do, is don't kid yourself on, what you're getting yourself into. Be real, be open, be honest about what it's going to take, and, have realistic expectations. And if you do that, I mean, we've seen lots of managers that have come through our advisory services that are in the hundreds of millions of dollars, today, that very, very successful. So,
Yep. I think that's great. Yeah, it takes longer and it's harder than a lot of people give credit to. And so
it's rewarding though. If you can do, you do it, you put your mind to it, and you take the steps necessary, and you do the hard work. It can be super rewarding, but be realistic. Yeah. That's what we're trying to help people with.
Absolutely. All right. Well, thanks, Matt. Thank you everyone for joining us, and we'll see you next time.